Richard Wyckoff started on Wall Street as a stock runner at age 15. By observing the private maneuvers of titans like J.P. Morgan and Jesse Livermore, he began to see patterns that the general public missed. He proposed that traders should view the market as if it were controlled by a single mind, the Composite Man. This is the institutional smart money that builds massive positions in secret before the price begins to move. While retail traders often react to news and small price fluctuations, the Composite Man follows a strategic plan to accumulate assets when they are cheap and distribute them when prices are high. Through this lens, market movements appear less like a series of random events and more like a deliberate process of moving supply from weak hands to strong ones. This process unfolds in a repeatable cycle. It begins with accumulation at the bottom, moves into a markup trend, reaches a distribution peak, and ends in a markdown. During accumulation, the market moves sideways. Retail traders, discouraged by a long downtrend, eventually give up and sell. The Composite Man uses this period of low prices to quietly absorb that supply. In the distribution phase, the roles reverse. As the public rushes in to buy the peak, the Composite Man offloads their holdings. The retail traders provide the very liquidity the institutions need to exit their positions. By identifying these phases, we can see that periods of intense market fear often represent the areas where the path upward is finally being cleared of resistance. To spot the transition out of a sideways range, we first define the boundaries. We look for a period where price oscillates between clear support and resistance levels. We add Bollinger Bands to visualize volatility. When the bands contract around the price, it signals a period of equilibrium, where the market is preparing for an impulsive move. We look for a specific alignment. A candle must touch or break the lower Bollinger Band at the same time the RSI drops below 30. This identifies a market that is overextended to the downside. When the market reaches this level of oversold volatility within a trading range, the Composite Man often initiates one final maneuver to flush out the remaining sellers. This is the Phase C spring. It is a sharp drop below the trading range support, designed to trigger stop losses and trap breakout sellers. If the price immediately recovers and closes back inside the range, it confirms the drop was a liquidity grab. The institutions have successfully swept the lows to fill their remaining orders. This rapid recovery leaves an institutional footprint called a bullish fair value gap. It appears as a three-candle sequence where the high of the first candle and the low of the third do not overlap, leaving an unfilled pocket of price. This gap represents an imbalance where the price moved so fast that not all institutional orders were filled. Look closely at the vertical space in this gap. Traders focus on the midpoint of this gap. Because institutions seek fair value for their remaining orders, the price often returns to this 50. This mechanical approach allows us to risk a small amount at the bottom of the range in anticipation of the upcoming markup phase. Hold the trade on a higher time frame until price hits major resistance or the upper Bollinger Band. Then drop to a lower time frame to spot bearish RSI divergence, which occurs when price creates a higher high while the RSI makes a lower high. This divergence indicates that the momentum of the markup is fading and the Composite Man may be starting to distribute. We close the entire position at this signal. By entering at the fair value gap and exiting on divergence, you align your trades with institutional intent. Success in this strategy comes from waiting for the footprint of smart money before you act.